Welcome to today's podcast. Thanks for joining me as always. I really enjoy doing these podcasts and sharing thoughts from certainly others, but certainly what I'm doing in my own personal financial life that hopefully helps you progress and manage and gain that financial freedom you're looking for yourself and your family. And so today I wanted to cover a basic topic. We're living in a world today where there's a lot of volatility. There's a lot of experts who are claiming that a lot of assets are way overvalued, whether it be the stock market, real estate, you name it, Bitcoin. And you've seen some correction more recently at the time of this recording on Bitcoin. But, it's the everything bubble, right? And just like a lot of bubbles, they have an opportunity to deflate at some point. And so today I really want to cover a topic that I think is very key at this stage of the game. Whether we can time the market, which we can't always, we don't know. But, when we're planning for things, one of the things that's so key in our lives is liquidity. There are some who say you always have to be invested at all times, and you got to wonder who's saying that and why. But, for those who are longer term wealth builders, they recognize the importance of having access to liquidity. It gives you not only comfort to know that, hey, you have money you can use in times of emergencies, which is the typical approach, but more importantly, you have ample resources to deploy when opportunities present themselves. Most people don't. They may have money that's tied up just in their home in equity, or it's in their retirement account, so you can't be able to access without penalties and taxes. And so a lot of people are not seeing significant amounts of liquidity, and it puts them in a potential vulnerable position as things change, which in life, that is an ultimate certainty. It's going to change. And when is just unknowable for most people. So being prepared, and it gives you a level of confidence and calm, I believe, to be able to strike when needed to deal with opportunities, but certainly be ready when things turn for the worse, potentially in your lives that you weren't expecting. And so today I want to cover just kind of general philosophies around liquidity, and then even tell you a little bit of some of the things I've been doing in the past year or so to prepare and regroup back to the liquidity that I felt more comfortable. And admittedly, there was a point where I probably even personally extended myself more than I should have. And so I've reversed course to some degree to build back more liquidities in areas now as we prepare for potential changes in the economy. For most investors, like I was mentioning, we're always looking to invest and earn the rates of return. Like, having money sit, say, in a bank account or something, earning nothing is eroding the value of those dollars. But it also discounts the fact that, hey, we can deploy them when others can't without having to liquidate assets. And that's what's happening when there's liquidity issues, that people will unfortunately may have to sell assets at a time they maybe didn't want to and expose themselves to capital gains, other things. And so those are things we're trying to prevent by having ample dry powder available to use. And I've used this basic philosophy when we're talking about liquidity and savings. One is obviously emergency funds, right? We will always want to have that emergency money available, whether that's 3 to 6 months. That's obviously a personal preference, and that may be dependent on kind of your situation, stability of your job, your health, other things that we cannot control that may cause some issues for us. But having 3 to 6 month dry powder is always, I think, a smart thing to have access to, whether it's in a bank account, money market, whatever. You can easily liquidate and use to kind of deal with any volatility in our lives. So we've always talked about this other side of things too, which is kind of how we started this podcast, is opportunity, having a fund available that you're ready to deploy very easily when others cannot, and creating that calm as the storms come, and they inevitably will come, that for those who are positioned properly to have, whether it be a year, 2 years worth of money is available to start deploying into things when there are suddenly discounts in the market, right? We always like to buy discounts, right? We like things on sale. But in the time when markets are only going up in one direction, you're buying potentially on the highs, right? When there's momentum and a lot of FOMO going on that you want to keep on buying into markets. And certainly when we're talking about the stock market and let's say 401ks, we're automatically buying whether we want to buy or not. Here we have a chance to step back and say, hey, maybe there's a better time to buy, and we can have capital sitting on the sideline waiting to deploy and ready to buy those discounts and be in a calmer position when markets become chaotic, or there's an opportunity that just comes onto your desk that you just didn't foresee happen. I've had that happen in my lifetime on a number of situations. So it's so key to have that liquidity. And so what have I done maybe in the last year or two that has helped build back the liquidity even in my own personal life? One of the key measures I've taken is looking at my broader sets of investments. Right now I have still a lot of rental properties. We had a very frothy market in real estate. We have a lot of headwinds and things like taxes and insurance costs. I took the opportunity to assess even some of my rental properties to see, are they even worth holding in the future, right? Given where we are in the market and how they're performing and what I foresee in the future in that market. And this goes into also stress testing, like where you're invested. So are you invested in places you understand and have some control over? That's one angle to it. So this is something that I knew very well, property that held for a long period of time. And at this stage, it holds a lot of equity into it. However, the economics around it did not look promising now and into the future. And so ended up deciding to liquidate that property last year. I was able to sell this property, sell it at a good time, and not even incur a huge amount of capital gains taxes on it because I had prepared with other losses that I was carrying on my books that could counteract that over time. But I was able to liquidate because what I was earning in terms of cash flow and potential appreciation of the asset wasn't really huge. And so I was able to unlock a lot of wealth in that asset by selling it. And I know I probably didn't reach the top of the market, but it was ample time for me to get out and get some money and keep some of those assets now ready as dry powder for me to use when I needed to. I was able to look at some of those and kind of see where they were coming to an exit and determining that I could have reinvested it back in and then now I would be less liquid. But I took the opportunity when those were sunsetting and I was able to access options to sort of withdraw those investments. I did so and decided not to reinvest in those situations. So I took some of those dollars back, and some of those are trickier because some of those are not as liquid. So I found ones that were close to ending and exercise my right to get my money back at this stage. And so you do have to be careful with some of those because some of those are not very liquid. Interest rates where they are, there's a lot of different types of these limited partnerships and such that you just can't get your money back out easily. So this is an opportunity I took when some were available. I was able to liquidate them, take some of the cash, and then again, add to my stockpile of dry powder to be able to take advantage of opportunities. One of the other areas which I think for a lot of families, if you've been able to own a home and live in it for a while, and we've seen a lot of price appreciation in different areas of the country, broadly speaking, we're probably in a world where it's a little higher. So you may have a lot of home equity tied up in your home, which is for some folks a good feeling to have. Right? You've got an asset that you're believing is building your wealth, and who knows where that goes in the distant future. But you may have untapped equity in there, and that's the equity in your home, although it's good to have because it gives you some cushion if the market turns. It is actually not really earning all that much, right? It's just equity just sitting there. It's kind of like dead money in there. And so one option is to open up a home equity line of credit. And those are offered by any banks, and maybe even your mortgage lender might offer that. And, it does require you get appraisal on their home and go through a process to open up this line, but you don't get charged on it until you actually start using it. And so at this stage, it might be very prudent because it's hard to get when things change. Say you lose a job or whatever, and they're going to see you have the ability to make payments on that. They won't give you that line of credit. So get it before you need it. And all this stuff is related to getting ahead and planning before you actually need it. If you needed it because of things happening, you may not be able to access these monies unless you sell that asset, which you may not be in a ready position to do it. That might be an option also, but depending on your situation, at first, check if you're going to be in the home for a little while, get a line of credit, open that up, and assess like what you can get based on the equity in your home, because it might be pretty sizable in accessing maybe hundreds of thousands of dollars to have on the ready just in case things turn or you see an opportunity. Now, you might be in a situation, depending where you are in your life and, your children, where they are, and, where they're moving on to college, etc. You might be in a position, it might be a good time to sell your home, possibly, right? Because right now the markets in certain areas, certainly my area in Connecticut, there's not a lot of inventory. So, homes are still getting top dollar for their home. So this might be a good time, if you can withstand it, to liquidate, get access to that equity. And then, you need to obviously find an alternative spot, which is always part of the challenge, whether renting or, buying a smaller property. It might be time that you might want to extract that equity out and then stockpile that money. One of the things too, and if anyone's who've listened to this podcast for a while, there are alternative places to store money, like bank money. Obviously, you have your bank accounts. Certainly, I've deployed some money and put some money into treasuries, which is a good safe area right now to hold, whether it's money markets, whether it's in your non-retirement accounts, but even in your retirement accounts. At least if you have in a Roth IRAs, you could liquidate some money there if really needed to, or invest. But one of the places we like to store wealth long-term is in properly designed whole life insurance policies. So in those situations, I've increased my contributions, because once you do that, then increases cash value and gives you a line of credit or a mechanism to just basically withdraw that cash. But you probably won't want to do that early, maybe later down the road. But it does open up a line of credit with the life insurance company, and that money in there is continually earning and growing tax deferred while you're also protecting your biggest asset, yourself. So that's a place I've diverted a lot of cash to build up those policies, and then give me a line of credit that's kind of sitting off the balance sheet, right? Because if you ever borrowed from that, doesn't show up anywhere. There's no credit checks, and so you can have access to those dollars. So some of the other things that are to consider is where you're spending your money. This is probably a good time to sort of start looking at different areas of where you're spending your money on both personal and business side of things, to see if there's anywhere that you can trim down your costs and keep some of that capital in your bank account. There might be spending that may have occurred and started that you may not even be aware of. I've cut down certain things, different subscriptions, different services that I really wasn't using or needing, and trimming that down, evaluating insurance policies for your auto and home, things of that nature that can maybe bring back more capital back to you. Now, the last thing I would suggest, what I've been doing too, and this is something probably is an ongoing thing, but it's really an important thing even for this time of year when you're trying to build more liquidity, is assessing and doing some tax planning, some proactive tax planning. At the time of this recording, here we are in December, so obviously time is of the essence around this type of stuff. But you can also think about this even for 2026 and future years, to get ahead of these things, right? To do some tax planning ahead of time so that you can adjust kind of your withholdings, estimate taxes you pay throughout the year. And so this goes into sort of some of the larger things. You're still potentially doing things like contributing to your retirement accounts, things of that nature, but you may want to look into other larger things like investing in sort of energy related investments, whether it be oil and gas, or doing solar and other things where you can take the benefits of the energy sort of related tax incentives that exist, and maybe even starting businesses that sort of can play in that space. Then you can act as that business owner and get depreciation, all those sorts of things. So there are plenty of options in that space, and certainly in the charitable world as well, that you may want to go exploring a little bit further with the right types of tax specialists and advisors to help you think through what are some options to basically partner with the government to do things that they want to do, whether in real estate, energy, etc., that can amount to large tax benefits for you for taking on that level of risk and prioritizing some of your wealth. But it actually can help you reduce your taxes in the future. And because you're planning on reducing taxes in the future, you can actually reduce your withholdings and your estimated taxes that you might have to fork over every quarter. Now you get to keep those dollars working in your world, right? You don't have to have them withheld for the IRS to pay someday down the road, because you're already positioning some of your assets so that you can take advantage of those tax benefits down the road. So something to really consider and manage. That's why tax planning is not an ending year thing. It is a whole year planning thing. People who are planning ahead for a lot of these things really recognize that. And so they're looking at these things throughout the year so that they can learn about them, adopt them, and then adjust how they're withholding or estimate taxes are paying throughout the year. So something to really sort of fine tune and take a look at, because unfortunately it is our biggest expense we're all going to likely face. People with success in their lives and incomes, your tax rate, actually your marginal tax rate, continues to grow. And then when you factor in your federal and state, for some people, you're in the 40-50 percentile range at that point, which could be hugely impactful if you can legally figure out ways to mitigate that and basically do the things that the government is actually incenting you to do, right? You just got to learn about them and get comfortable with them and get the right partners to help you implement those things. Hopefully that gives you a lens of the types of things you can maybe start considering to, increase your liquidity and give you more sort of dry powder to be able to, one, be just more comfortable and confident with that when the volatility does hit, that you don't have to act quickly or sell things quickly. But it also gives you that sort of a positioning that you can start pouncing when opportunities present themselves, which they likely will. You can go against the grain when people are panicking and maybe be confident to go invest and get things at a discount and sort of find things of value that others are just not able to do. Obviously, we talked about a little bit of emergency funds and the opportunity funds, but when we talk about liquidity, it kind of comes in my mind, three different layers. One would be just cash in the bank, right? We're always going to have some cash in there, at least these days. Having access to that is still an option, right? It's not going to be earning a heck of a lot, but there are things in that at least you can transact and have something else. So having a month or two, few months there would be good. The next layer is somewhat equivalent to that, but maybe not as successful. But second layer could be like, a money market accounts or treasury bills and things of that nature that are fairly liquid. You can get into them not as easily as a bank account, but pretty easily, and they're safe, earning a little bit more, but most of them are going to be taxable, right? But it's a good place to store some short-term liquidity that is sitting outside the bank sort of world that would be earning a little bit more and doing more for you. And then the last one is your borrowing liquidity. I call that it. And that could be obviously lines of credit, obviously credit cards used properly, right, could be in that boat. But then, you're having money in cash value and life insurance is a third sort of element of borrowing capacity, right? Because you borrow from the life insurance company in that scenario. So that's another layer of liquidity that can give you access. So when you combine all those, that's really, and obviously we're talking about other things too, where you can just liquidate, but obviously I'd rather you not liquidate things unless you really want to proactively, right? We don't want to be in a position to have to sell. And that's where you might actually lose value and then deal with other consequences of taxes that you may not want to. You may want to hold on to that as assets. So this is to do it proactively, strategically, and then set up your layering structure of the types of liquidity that you'll have access to. So that's all I really wanted to cover today, and hopefully it gives you a flavor of types of things. Definitely talk to your advisors, others to start to think about ways to start building this up. But, I think this is the type of situation where you use the Warren Buffett sort of phraseology around when the tide goes out, then who's swimming naked, right? And swimming naked is having no liquidity or investing in things that you shouldn't be investing in. And so having liquidity gives you that cover and confidence to go out there, even when the volatility hits, that you can actually act and invest in things that others would not be able to. You'll have it and you'll be able to take advantage of situations like this at times when no one's really expecting or knows when it will hit, but you'll be prepared to do it. And I think planning ahead is so key in a lot of things in wealth building. We get so pressured into trying to hit that home run and gamble and sort of take the massive risk, almost glamorized. Something as basic as having more liquidity in our lives can obviously give you more comfort, safety, and then just give you more opportunities to act when others cannot. So I hope this was helpful, and always wishing you the best around your wealth building. And I applaud you for continuing to build on your education so you can shape your approach to building your wealth. Take care, and we'll see you on the next episode. Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.